Welcome back to Trendlines over Headlines, the show where we break down the markets with some of the best traders and analysts out there. We've got a great show for you this week. Frank Cappelleri is joining me. Frank is a highly respected analyst on the street. I'm lucky enough to call him a friend and mentor. He actually sponsored me for my CMT a few years ago. He started his career at Smith Barney in the early 2000s, working alongside legendary technicians like Louise Yamada and Alan Shaw. And after spending over 2 decades servicing institutional clients, Frank started his own firm, CappThesis, where he provides research to active investors. He's been featured in just about every major financial publication, from the Wall Street Journal to CNBC, so we're really lucky to have him on the show today. But before we talk to Frank, it's Friday, the markets are closed, so let's take a quick look at how this week played out. Hey guys, thank you for watching. Just a quick reminder, be sure to click like and subscribe so we can continue bringing you awesome content. Thanks. All right, so it was another volatile week, especially these last 2 days. The Dow was the only major index that closed higher, rising a little over 1%. The NASDAQ was the laggard, dropping about 3% on the week. Now, taking a closer look at the S&P 500, we saw one of the biggest intraday reversals in history yesterday. You can see that candle there basically engulfed the prior 4 days of action, but it couldn't follow through on that move in today's session, and we ended up giving up about half of Thursday's gains back today. We briefly reclaimed those June lows yesterday, but here we are ending the week back below them, so not the most bullish way to end the week. Now, taking a quick look at the sector performance, consumer staples, healthcare, and financials were the only positive sectors on the week, while tech and discretionary led to the downside. Anyways, that's enough for me. Let's welcome Frank Cappelleri onto the show. All right, Frank, welcome to the show, and thank you for coming on today.
Patrick, it is my honor. You've done a great job with the chart report, and now adding Trendlines over Headlines to it. I'm really excited to see where you take it from here. So thank you.
Oh man, I appreciate the kind words a lot, and I also appreciate everything you've done for me. Sponsoring me for my CMT and everything you've done at the chart report. You used to share your daily notes with me back when you worked at Instinet, and one day they just kind of stopped, and I missed them terribly for a couple months. But I'm happy to see that you're back at it. And so you and I know each other really well, and we've got a lot to cover. But before we get into the market stuff, could you just give the viewers a little bit more background on you and your time as an institutional sell-side analyst, and also your new venture, CappThesis?
Sure. Well, thanks very much. Well, we can go all the way back. It's been 25 years, but I did get a very interesting start working with Alan Shaw and Louise Yamada at Smith Barney, which is now Citigroup, in 1997. So right as the internet boom was really taking hold. And now that was a crazy time, of course, right? A lot of day trading, people making so much money. Talk about FOMO. That was a really interesting part of it. But in sitting with them, right, they've been in the game for a long time. I found it, I would say, comforting now looking back, is that every week you sit there in the meeting and review every industry chart very carefully and the relative chart versus the S&P 500, knowing that we would stay in the trend as long as we continue to outperform. So week by week, nothing crazy, and that kept them in that rally, basically the vast majority of it, right until the top. And again, removed from emotion, just because of just the way they were looking at it. So the other part of that time frame was that I was convinced at the time that being overbought was the best single thing you could possibly be in any market environment, considering it was the only market environment I knew. So in about March 2000 actually, I went to Instinet and started working with a gentleman named John Schlitz, who was a over-the-counter trader at Lehman for many years and also did some technical. Walked into a bear market about to start when we didn't see an overbought chart for quite a long time, focusing more on short term as well. So I quickly learned that there are time and place for different types of indicators, and markets change all the time. And so from there, I had many different positions at Instinet, mostly as equity sales trader. Also spent some time in a research sales desk working with other research salespeople. fundamental analyst, and my last few years there, I was a desk strategist. And all along the way, it really afforded me a lot of opportunity to work with very successful investment firms across the board, buy-side traders, buy-side analysts, and also portfolio managers. And from that time, learned exactly what they want to see, how they want to see it delivered, and how frequently. And really, that's how CappThesis was born, and that's what our products attempt to produce right now. So if you look on the website, you'll see there's a morning piece every morning called Morning Trends, an afternoon piece called Last Licks for all you baseball fans. There's also a weekend piece, or one that comes out after every period. It's a week, month, and quarterly called Postscript, where we look at all different asset classes, the winners and losers, but also charts from that specific period and good setups going forward. And it's all augmented by a video series we have called Breaking Out. Now, all of them are designed to be easily digested, to be clear and concise, and knowing that there's another piece of information right around the corner, right? Because if you're an active investor, you know the market is ever-changing. You don't want to wait too long to get another piece of information that could help you. So, and they're also designed to come at you a little bit differently. So if you look at the morning trends, it's presented in one way, the afternoon piece presented in a different way. And I would say that the only way to really find out is to go to the site, subscribe, and once you do, all the content will be unlocked, and we have about a month's worth of content in there right now.
Yeah, I mentioned that I used to really enjoy your notes back when you were at Instanet. And I got to tell you, I think I like these ones better. And what I like about them is that they're snackable. Nobody has time to read a whole research note these days. And, you're really just hitting on those key points, the interesting things. You said concise, and that's really the name of the game. And you're bringing 2 decades of experience. And like you said, you must have learned a ton working from some of the greats like Louise Yamada and Alan Shaw like that. So definitely go check it out. To our viewers, if you haven't, it's CappThesis.com, right?
You got it.
Awesome. Well, let's get right into the market stuff. What a wild day in the market. I mean, so we're recording this on Thursday after the market closed. And wow, what a reversal we saw today. I think that was the 5th largest reversal in the history of the S&P 500. We opened down about 2%, closed higher by more than 2.5%. I think total, we rallied about 5% off those intraday lows. So just a monster change of character, and on bad news too, on a kind of ugly CPI print nonetheless. So what do you make of this reversal we saw here today on Thursday? Do you think it's just short covering, or is it the start of something more meaningful? And I know you're a big pattern guy, so also, what are some of these patterns that you're seeing develop? But we'll start with your thoughts on today's massive reversal. Yeah.
Well, I think there's one phrase I use a lot, and it's that the reaction to any news is more important than the news itself. And this was like the epitome of that today, right? And so a lot of that has to do with positioning. We knew that S&P came in down 6 straight days, second time in the last 3 weeks, and already oversold. And so professional traders like to see the sort of reaction like this, where you have a bad number, bad reaction after being down for a long time. At least gives you the ability to take a shot. You and I were talking about this just today, about when is the right time to take a shot, and you can do so. If you do so at the beginning of a day, it's very easy to put a stop there. Now, if you did that over the last 2 weeks, it wouldn't have worked out that well, but this is the start. And as we go forward, the key thing with any one of these big moves on a short-term basis is the pullback that comes afterward. And you need a higher low, right? The higher low is the beginning stages of a potential pattern, a bullish pattern, and you need bullish patterns to work a lot more. And so that hasn't been the case. What has been the case are bearish patterns working. And we have a lot of those charts on there today to look about that, to see a little bit more about what we need to do to change things. And so on the first chart is a big picture of what's happened over the past year or so. 2 really big tops, right? I think that's important to look at. Number one, when we started to roll over at the beginning of the year, not many people thought a big down move like that was possible. And we have been down consistently, but it hasn't been a straight shot down. You have opportunities, and when the consolidation patterns have occurred, they've formed bearish formations, and more time than not, they've played out. And so on the second chart, you see this on a more short-term basis. And now, Patrick, please don't report me to the chart crime crew here, because I have 3 patterns on one chart here. But I thought this was an interesting look to see how this developed. And this was just from the summertime when it topped out in August, right away formed a bearish top, and the pattern there outlined in black, and then it formed a bigger one. And so on the next chart, you'll see that both of those smaller patterns played out, right, like textbook, right? You had a breakdown, automatically hit the downside target there, the initial rip higher from there, failed at that breakdown point, then formed a second bearish pattern, and then that target was hit, right? And so with no real bouncing opportunities, a much bigger pattern then was formed, which we saw a breakdown in the middle of September, with a target now near 34.75. And so the way I treat these is that, I get asked a lot of questions about, how confident are you that these downside targets, or upside targets for that matter, will get hit? I'm like, it really doesn't matter what my confidence level is. It all depends on if those breakdown points get respected or not. And so as you can see, it took a few days, but we never got back to that 3,900 level. And as the market continued to roll over, it got closer to that point. And so that's the target always remains in place as long as you're below breakdown point or above a breakout point, right? And so we got to within 16 handles of that today. So, percentage wise, you're just about there. And that's when the market started to turn. Coincident or not, right? That basically satisfies that downside target. And the most important thing now is to build from it. So if you go to the next chart, you can see that that's what's been failing. We've had a lot of short-term bullish patterns along the way, like very short-term, right? Intraday and over the course of a few days, those get hit on the bear market rallies. But when things really start to build a foundation, like we saw here from May into August, they're running out of steam. And so that, as we know, that on August 16th, it got very close to both the 200-day moving average and the downtrend line year to date. It also came, it failed on a bullish pattern. That really has been the theme all year, which is a direct opposite of what was going on from, say, April 2020 all the way through November of 2021. And anyone who has read my work over that time, we continue to talk about the opposite of that, where every bearish pattern failed, right? Sometimes got some breakdown points, but they never really came to fruition until things started to change toward the end of the year. So now we have the complete opposite. The common theme is that you're still in the trend, right? You're in a downtrend right now, but the same things are happening. You need a combination. Majority of bearish patterns equals a downtrend. Majority of bullish patterns equals an uptrend. You have a lot of infighting between both of them, and they fail back and forth. You're known as sideways, very volatile trading range.
Yeah, so correct me if I'm wrong, but what you're kind of saying is this year has largely been defined by a lot of different bearish patterns in multiple different time frames, right? You have the larger scale, longer term bearish patterns, and then you have the smaller bearish patterns as well. And those have been successfully working, and the bullish patterns haven't really materialized at all. Is that right?
That's right. And that's the simple way of putting it. And that's what I always say, right? I write about that and talk about it a lot, but that's the crux of it. If you think about how trends are created, that's how they are. It's never just straight up. The downtrend line looks really good, going straight down, but there's a lot of action underneath the surface there. And you need, a lot of people don't focus on the short term, which is fine, but I think this is where you get the clues, right? If you have a majority of shorter term patterns working in your favor, that's going to build a much bigger foundation of which to get leveraged.
Yeah, and I think I really liked what you said earlier there about how, heading into today's massive reversal, you had 6 consecutive down days. And I remember one time asking you, Frank, why do you pay attention to streaks so much? Isn't it just a fun fact? But I thought your explanation was really good. So could you tell us a little bit more about why you do pay attention to those streaks?
Sure. I think anytime a streak like that happens, or even an exaggerated move in a short amount of time, it makes a lot of headlines. And you think it's like the first time ever, or it's a very rare event, right? Sometimes it is, but we have the ability now, of course, all of us, to have data in front of us and go back and check to see. And oftentimes, if you go back long enough, you find instances where they happen to be in the same sort of markets that we are now, and can give you a little bit of an idea of what to expect going forward. Now, they're all probabilities, of course, but it's better than acting in a vacuum, so to speak, right? And so I think those are in particular helpful when you say you have an oversold indicator that suggests a bounce, but you're also near multiple forms of support, you're down at a certain amount, and everything kind of lines up. Well, all that does is it increases your confidence level, right? Your conviction level. So if you wanted to put on a trade, you can do so, again, using a stop, but knowing you have 4 things now going for you as opposed to just one and a hunch.
Yeah, and you mentioned that those streaks can often kind of symbolize a sign of exhaustion, right? Or that the trend's kind of reaching an exhaustive point. Is that correct?
That's right, too. And I thought, in particular, writing about this the past 2 days, is that you had a 6-day losing streak, of course, right now, but it was the second one we had in 3 weeks, right? That shows a lot of weakness. But if you go back in the beginning of the summer, you had 2 5-day losing streaks about a month apart in June and July, right? And the second one in July basically marked the low. And I thought it was interesting to see that because they look similar. And it was 3 months ago when July happened, right before earnings season began, right? So we're at earnings season again now. So it's symmetrical. No time is completely the same, but it's interesting to see how they lined up.
Yeah, and here we are again, just earnings season's right in front of us in the next few weeks. I mean, starting very soon in the next few days. But I want to get your take on utilities here. This is a sector that's gotten a lot of buzz. It's had a serious fall from grace. Here it is down about 20% off its highs. And just a month ago, it was at all-time highs. It was the first sector, coming out of we're still in the bear market kind of, but it was the first sector in this cycle to hit an all-time high. And you pointed something really interesting out. You had this tweet around the time it was breaking out to an all-time high, and you said, utilities kind of have this habit of these false breakouts, and a lot of these times these breakouts have been better fades, right? And it would have been one hell of a fade. I mean, it's down 20% in a month. I mean, that was one of the fastest drops for utilities in terms of price and time that we've seen in the past decade. So what do you make of the fact that a defensive sector like utilities is getting hit? Should the bulls be encouraged by something like that, or?
It's a great question. I think there's a few ways of looking at it. One is we have this long-term chart here where this goes back over 20 years, and we just have highlighted that other times when there's been a 5-week decline of at least 20%. And needless to say, they all came during pretty harsh bear markets, right? Have one in 2020, quick, but still obviously painful to sit through. In the great financial crisis, it happened twice. And then when the internet bubble burst, it happened twice as well. Now, what I thought was also interesting about this chart is that those big, really huge down days happened toward the latter half of those bear markets. Now, this is just utilities. Obviously, the S&P will look a little bit different. But as you said, it's considered a safe haven, so to speak, right? A defensive area. Those are typically the last ones to get hit, right? For liquidity purposes. And so the way it's been moving over the past 2 weeks was like nothing we've seen, again, since at least 2 years ago, going back even further, the worst times in its history, again, looking at, say, 25 years worth. So if that's the case, does that mean now, are we getting toward maybe the midpoint or the end of this portion of the bear market, wherever it is? So I think it's something to think about. And it really, again, this is one of the reasons why we go back and check to see, does anything pop out? And I think, go ahead.
And I think it's really interesting too that, in the 02 scenario and the 08 scenario, you had kind of 2 of those negative momentum thrusts, right? So like you were saying, kind of maybe later innings of the bear market. And maybe we get another one of them, right? And maybe that one marks the final low or not. But sorry, go on.
No, I was going to say, if we were to look at that previous chart again, as it was better to fade breakouts, over the past year and a half or so for utilities. It's also been a good time to buy after it fell back to that rising uptrend line, which did not work out this time. Didn't stop at that trend line, and it kept falling pretty far from there.
Yeah, I see what you're saying. And it's fallen right through that trend line.
Yeah.
So let's move on to this chart you got here. You got utilities and rates. What are you thinking here?
Right. So that's a 10-year note, so bonds. So for the longest time, as you can see from the beginning of that chart, it's very striking through 2019 until right when COVID hit. XLU and 10-year note moved together. And that's one of the reasons why they always call XLU a bond proxy because they were so tight. I remember actually writing a number of pieces during that time frame before 2020, showing that when one got ahead of the other, it was just a matter of time before they caught up because that discrepancy was so tight for so long. And then clearly things got completely blown out of the water after COVID, where you're basically pinned to zero, and rates can only, the bond, the note can only go so high. And the utility started that very distinct and rugged advance there. And so it doesn't look like anything like it until the last few weeks again, when 10-year yield blasted through or close to 4% and notes sold off just like XLU. So I think that's one thing to consider, and it's kind of curious to see if now they maybe start moving together again. I'm not really sold on that idea just yet because of what's happened the past 2 weeks, but it is something to think about going forward. There's also another part, the next chart I wanted to touch on too, which I think can explain it. So this is the XLU overlaid on the TAN solar ETF. And the reason is that if you look at the components of XLU, it's over 60% of it is electric utilities. So if you think about the move for clean energy, so to speak, right? You hear solar and you hear electric. And so these are not moving together, but if you see the huge run up that TAN had from 2020 lows until the beginning of 2021, XLU had a pretty good run. That's when it really started to separate from the 10-year note. And then again, TAN started to come back a little bit more prematurely before the S&P 500 again over the summertime. That's when XLU had another push toward the highs. The crumble it's had since then has been pretty impressive as well. So as TAN solar ETF broke from some support that it had previously pushed back above, and then started to roll over and hitting more and more levels lower, you had the XLU do the same thing. Again, is this lining up completely? No, but if you read some articles and you see it out there, XLU is very much aligned as a spot to possibly invest to get some exposure to the EV or the clean energy market. So something to consider going forward.
Very interesting. Very interesting. So I want to get your take on energy next. Still the only positive sector year to date. It's up about 55%, which is just wild. And it's been a choppy mess since the summer, right? But it's really reasserted itself in a big way these last couple weeks. Last week was its best week in nearly a year. It rose like 13%. So is it still the place to be in terms of sectors? What are you thinking here?
I do, for one reason. I like the patterns, right, and the trends of XLE across different time frames. So we can see it here, like you mentioned, it had a really tough time, got hit really hard in June, has had a tough time coming back, but recently, right, had that big run up. So the hope was, again, talking about patterns, after a big run up, the most important thing is how the pullback looks. And the hope there was that it would form this potential right shoulder, inverse head and shoulders pattern, and then break out from there. So far so good in terms of what it looks like. The movement has been very extreme recently, so I'm not sold this breakout's going to take us back immediately to new highs, but I like what it's doing so far. So maybe consolidate a little more and then try again to make it through 84, then back up to the 90s. But I think if you turn to the longer time frames, you can see why it's so interesting. And so this is now a weekly chart. Oh, I'm sorry, daily chart, but zoomed out a little bit more right there, right? And so as it's getting close to that point where it failed in June, it actually could be building a much bigger, we want to call this a cup and handle or double bottom as well, right? And that's just encapsulates 3 or 4 months worth. So again, one bullish pattern that can get completed, right? Then creates another one. That's the steps you want to have this then continue to go forward.
Yeah, I mean, we're basically, the next upside objective from here is kind of those June highs, right? Where we started kind of chopping around this summer. And as you're kind of pointing out, these last 3 months, as choppy and as messy as it's been, we've kind of built this little base. And if we reach those June highs again, it was your mentors who first said, the bigger the base, the higher in space, right?
That's right. And again, we have to look at this as a part of a bigger trend as well. So if we even zoom out even more, right, it's all taking place within this long upper sloping channel, right? And so that's why it all falls together. So you hear a lot of people saying, by the dip in energy, wow, it got killed, but look what it did. All it did was really come back from a very extended level back in the spring to then come back to the lower threshold of that channel, right? And so to me, does a good buying spot, and it still is. It's because it really isn't up to back to where it was before. It's taken a lot of beatings. It probably knocked a few people out of the trade, got there late. So as long as this trend holds, I have no problem continuing to, buy and support what's going on with energy just based on the chart, right? This is what we're here for.
Right. And I think you could, again, if we do reach those June highs again, I think you could almost view these last 3 months for energy, for 3-4 months, as constructive, right? Because they had such a strong run up in the first half of the year that, if that uptrend is going to continue, you'd expect at least some period of consolidation, and maybe that's what the last 3 months were. But you got a longer term chart here. This is a monthly chart of XLE. Why don't you break that one down for us?
Yeah, so it may get challenging again, just because we see what we're coming up against, right? The 2014 highs right around there, and also where it faded in 2008. Now, I think there's going to be a common theme here, especially when we talk about 10-year yield and the dollar, is that you're getting these points of areas that have underperformed for so long that you're getting these overbought readings on a monthly chart, which is what we just got before on this as before it pulled back. And so if you just looked at this until say 2013 and 14, it will be a screaming sell up here because it got up to say around 100, and the RSI got to overbought, big red arrow says sell, right? And so same thing right before 2008 crash. But what I care more about is what it did from say 03 up until that point, was where it started to rally, and then it first got that overbought reading on the monthly RSI, and that held for years. You can see
Literally
it there,
like 4 years, 3-4 years. Yeah.
So it doesn't have to stay overbought, but that just shows that there was a regime change back then. A regime change had to occur for that to happen now again. And so, there's obvious resistance here. It still looks, I want to say parabolic, but very steep uptrend over the last 2 years. But, we have the ability to look at the daily, work at the daily patterns, look constructive, weeklies as well. And I think if that continues to go along, and you're patient with how this plays out, you still could be in for a good amount of run and energy.
Yeah, so I want to move on to the two wrecking balls, which of course the dollar and rates. Speaking of parabolic there, and I know our viewers are probably sick of hearing about the dollar, but they just keep going, and rates. And they're such important pieces of the puzzle here. I mean, both of them have been trending higher, and that's really put pressure on stocks. You have this great chart here, basically illustrating that point. They've been moving higher together, and as they have, the S&P 500 has really struggled. So let's start off with rates. Do you think the 10-year has more juice in the tank in terms of upside here?
Long term, I do. And looking at that chart, it talk about something that goes parabolic. But remember, where that 10-year yield came from, zero, basically, right? And overseas below zero. And so you're getting back to a point where I want to say it's going to be normalized again. But we know what the deal with inflation, we know what the Fed is trying to do and all that, and we know what's leading that 10-year yield is leading. And so because of that is going to create, again, an overbought reading on a monthly basis. You see in that and the other chart there, where we haven't seen that in quite some time. You see how far back we had to go, right? To the 80s.
Yeah, this is a quarterly chart too, right?
Crazy. But the same argument, if you just go back to the last time it occurred, it just shows you the last bit of an extended run in rates. And that's when it ended. But if you go back to 60s and 70s, as you were going up, in rates, as you were climbing, the RSI was between 80 and 90 for years.
Yeah.
And so not that we're going to have a repeat of that, but you have to go to a time frame that's before a lot of us really in the markets to get an understanding of what this possibly was like, right? So the 70s is a good part of it, but even before that, to understand what a rising rate environment is like. Now, that could really scare people hearing that, knowing what's happened this year. But if you go back to the 70s, and we were talking about this before as well, I believe, is that From 1970 to 79, the S&P moved about a net 20%, right? Basically done nothing for a decade, the lost decade. That was inflation. But along the way, you had really big moves year to year, right? So you had to endure some bear market activity, but also some big moves. So I think, that's a time frame we have to keep it in the back of our minds, or a blueprint as we go forward, because this could be the beginning stages of a regime change. Again, it doesn't mean we're going to have to go down 20% a year until we get a handle on inflation or things come back. It's just going to be one of these back and forth movements as things go along.
Yeah, I mean that trend, the uptrend channel that you have there, I mean, still intact. And I like what you said there about RSI and how, a lot of times when it gets overbought, that's one of the more bullish things that can happen, because it's kind of counterintuitive, right? Overbought sounds like it's been bought too much, when really it's really a sign of strength and momentum. Isn't that how you think about it?
That's right. If you go back to what I said when I first came into business, right? Looking at the internet stocks staying overbought. And again, I think we have to sometimes forget about what we're looking at and just be like, if you're a technician, you care about price, you see something going up with an upward sloping trend that keeps on respecting the lower level of an upward sloping channel as the RSI oscillates between the midpoint and overbought, all those are a sign of strength. We know at some point that consistency is not going to be there, but you can't guess when it's going to occur. So, with the 10-year yield going like this, as long as it continues to respect a higher low, I can see this going higher. I do think the rate of change probably will have to slow down at some point, but if this is going to work itself higher at that point, then it's going to, form a high level consolidation and possibly identify a bullish breakout, then to go higher from there.
Good stuff. Well, let's move on to the dollar here. It's going parabolic, and it's kind of running into that Fibonacci extension from the 2017-2018 decline. So, are we at a point where we can at least expect a pause for the dollar?
Well, I think this suggests that we have to go to the longer term chart, which you have there as well. Yeah, as we go, even one that looks at from a monthly basis, yeah, right here. So as you get closer, you're getting to the top of that multi-year trading channel as you're getting to the top where it was back in the early 2000s, right? Right near, between 116 and 120. So you're right there. So I would say this, Patrick, if it's going to slow down at some point, it should happen around now, right? Everything's lined up where, again, you're overbought. We know that's good longer term, but you're getting close to resistance. You're getting close to the top of the channel. If it doesn't slow down now, then I don't know what is going to slow it down. So I think there's enough to, again, suggest maybe a rate of change could slow down just a bit. But as long as any pullback, keeps its monthly RSI, weekly RSI, however you want to look at it, within that upper half, again, you have to assume that trend overall is going to stay higher.
Yeah, everyone wants to call a top in the dollar right now. I think people genuinely want it to go down because it has been such a nuisance for the rest of the market. But, like you're saying, it might slow down its rate of ascent, but it might, not be done in terms of an uptrend. It might just be on pause if it does ultimately reach resistance sometime soon.
Yeah, well, I would say on a daily chart too, it's like one of the things that buyers of the dollar have gotten used to is that you're buying it on a dip and you're expecting new highs right away. And so, we had a really big spike a few weeks ago. We're not quite back there yet, just yet on the daily. So if that happens, you could have potential lower high, which then could form a short-term double top, something like that. And if that happens, right, as yields pull back, and maybe you have some surprises in earnings season, potentially then the seasonality kicks in for, the market of the fourth quarter. That's when you can have an extended bear market rally. So a lot of ifs, but those are the things that could possibly transpire over the next few weeks.
Awesome. Well, Frank, I think we got to wrap it up. We're running out of time here. But before you go, just one more time, just tell us a little bit more about where they can find your work if they're interested.
Sure. Well, we're on Twitter at Frank Cappelleri, and then the website is CappThesis.com.
Awesome. Well, Frank, thank you so much again for joining us today, and I hope you have a great weekend.
Thanks so much, Patrick. It was great.
Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week. Thanks.